So, welcome back. This is the material pertaining to Chapter 19, where we're going to talk about the Phillips curve. And where this fits with our previous material is that we are going to, in Chapter 20, combine the analysis of Chapter 18, which was the IS and MP framework that allowed us to talk about the determination of the real interest rate and the output gap, and to consider how that varies over the business cycle. We'll combine that analysis with a discussion of inflation. And so, in order to do that, we need to introduce this inflation idea. And so, what we're going to do is to first of all think about why there is inflation in the macroeconomy. So, we'll note that there are three causes of inflation. And what we'll do then in turn is explore each of them. So, explore first inflation expectations, and then secondly, talk about a concept that's known as demand pull inflation and use that to develop the Phillips curve. Then the third thing that we'll do is to consider shifts in the Phillips curve and use that as a motivation for the third reason why there's inflation in the economy, and that's the existence of what's known as cost push inflation as a result of supply shocks. We'll talk a little bit about policy and implications. And then at this point, what I want to do is just look ahead to the material in Chapter 20, not do a whole lot in the way of formal analysis at this point. So, when we think about inflation, our principal objective in this chapter is to explain why there is inflation in the macroeconomy, meaning what are the causes of inflation. And there are three things that we think of as driving inflation or resulting in inflation in the macroeconomy. One is the existence of inflation expectations, which is, in other words, looking ahead to, say, next year and incorporating those expectations into current pricing behavior now. The second reason why inflation happens in a macroeconomy is because of demand pull inflation. So, this is inflation that is unanticipated or unexpected and occurs as a result of shocks to the demand side. So, if you begin to think about, where were we with the Chapter 18 material, that was all a discussion of the demand side of the macroeconomy. And then the third reason that we'll talk about for why inflation happens in an economy is the presence of supply shocks or cost push inflation. So, in other words, inflation that results from unexpected changes in production costs. And so, what we'll see is that quite literally, in our example, we'll think about the actual rate of inflation that's experienced in the macroeconomy as being the sum of of inflation expectations, the inflation that's due to demand pull factors, this, and the inflation that's due to cost push factors. So, for instance, if it were the case that if this is zero and this is zero, then so if those things were true, then it's going to be the case that the rate of inflation would be strictly what was expected. So, if you recall our earlier notation, we used a pi for that's the symbol for inflation and superscript e for expectations. So, the underlying rate of inflation today is the one that is expected. And then, if there is positive inflation from demand pull reasons or cost push reasons, then the rate of inflation would be higher by that amount than the expected rate of inflation, and vice versa. So that's what we're going to turn to in what happens next. So with that, what I want to do is introduce the first of participation questions with this context. So what I'd like to do in order is think about these sources of inflation. So, inflation expectations is what we saw as the first source or cause of inflation in a macroeconomy. And what we're thinking about in this context is the idea of decision making. So a business that's considering what prices to charge today, or in a dynamic sense, how much their prices are going to rise, is going to consider a number of factors. One of them is input costs, or their own marginal costs. So if their marginal costs of production are rising, then of course the output prices would be rising as well. They're going to consider their competitors' prices, because as their competitors' prices change, then that can influence the business in turns, its own prices. So, in other words, if it were the case that your rivals were increasing their prices, you would have some leeway to increase your prices as well, and not sacrifice the loss of market share. And then similarly, you're going to look at information about future prices, things that you understand are going to happen in the future, apart from what your competitors are doing. So if you knew, for instance, that you had a labor contract with your employees that would stipulate a certain escalation in wages, then you would build that in. It would be something that's known. The key idea here is that expectations matter. So the idea captured in this graph here on the right side of the screen is one that I just lifted from the textbook, and it was the idea that, for example, restaurant prices tend to rise in line with inflation, because restaurant owners are looking at the rate at which current prices are rising in their with their competitors, the increase in their expected costs, and then any other kind of known things that are going to happen that should affect the firm's costs and prices. And so you see, the blue represents annual inflation. Oops, the blue represents annual inflation. The red is the actual changes in restaurant prices. And the idea here would be that as as actual inflation is rising, so as we go this way, then so too are restaurant prices. And as actual inflation, on the blue, is starting to go down, then so too are restaurant prices. So that these things are highly correlated. And this is what we're getting at with this idea that expectations matter. More than that, what we can remark upon is the idea that what we observe in the macroeconomy is that expectations tend to be self fulfilling. In other words, expectations occur because, or excuse me, inflation occurs in the macroeconomy because we expect it to. So, in other words, inflation expectations are going to create a self fulfilling prophecy. And that self fulfilling prophecy, importantly, can either give rise to what's known as a virtuous cycle, which is illustrated here on the right in blue, or what's known colloquially as a vicious cycle. So, in other words, if businesses expect that prices are going to rise by 2%, then they're going to increase their prices by 2%, ensuring that, in fact, prices do rise by 2%. So, this is the idea that inflation expectations create actual inflation. And if it were the case that instead we saw an economy in which businesses expected prices to rise by 20% or 50% or thousands of percent in the case of hyperinflation, then businesses would increase their prices accordingly. So we can see that in economies, different performances are very much rooted in this premise of inflationary expectations. High inflation countries are often just stuck in this vicious cycle, and low inflation countries tend to enjoy a virtuous cycle. What we're going to see when we talk about the material in chapter 22 is that which is dealing with monetary policy, there's a very important role for policymakers in promoting price stability. In other words, policymakers, particularly, say, the Fed, will undertake actions and communicate in words that people should expect that inflation will be low in the United States. And in turn, what we have seen is that those expectations are realized. Interestingly, and we'll introduce this towards the end of the chapter 22 discussion in 2 weeks, the Fed recently changed its monetary policy stance effective in October to try to communicate as loudly as it could that it wanted to see a somewhat higher rate of inflation in the macroeconomy. And I have some examples that I'll share on Canvas at that point, dealing with this question of credibility. Can the Fed be believed in its ability to undertake that particular monetary policy stance? So, what I want to do at this point is stop for another participation question, and then we'll proceed most of the way to the end of the notes before we hit the remaining one or two participation questions. So, what I want to do at each of these junctures is to just offer a brief review. So remember that we said that when we think about the existence of inflation in the economy, inflation is going to be due literally to inflation expectations. Plus, as we'll see next immediately, demand pull factors, demand pull inflation, plus cost push inflation or supply shocks, the impact of supply shocks. And what we've been focusing upon at the outset here is this initial piece that we have inflation in the macroeconomy because it's expected, meaning that businesses set prices taking into consideration the expected increases in input costs and competitors' prices. And the thing that is key here is that this is expected or, essentially known to be happening in the future. These expectations of inflation then become self-fulfilling. If we expect prices are going to rise by 2%, we'll act as if that's the case in terms of individual pricing behavior, our demands on the labor side for negotiating higher wages, and so forth, and that will then materialize in realized inflation. What I want to emphasize, because I think it becomes a little bit tricky in what we're about to transition to, is that in this discussion in chapters 18 through 20, the focus is on the short run. And the feature of the short run is that once formed, these inflation expectations are assumed to be fixed. Now, I suspect that this is going to become a little bit more transparent in what we do in these notes and should become much more transparent as we practice with the application of this model in the context of the chapter 20 material. In chapter 22, we'll devote a little bit of time to thinking about how monetary policy, so that's what I mean by MP here, monetary policy can influence longer term inflationary expectations. But for now, what we're always going to do is couch our subsequent discussion on there is a given level of inflation expectations, and then is it the case that inflation is different from that? If so, it has to be because either there is some demand pull inflation or some cost push inflation in the economy, or indeed it could be both. So, what I'd like to do is, before leaping into this discussion of what we mean by demand pull inflation, to try to give you some sense of how Chapter 18 evolves into Chapter 19, which then in turn evolves into Chapter 20. So in chapter 18, we described a macroeconomic equilibrium where we said that when there is an excess demand for goods and services, so by excess demand, we mean for goods and services in the macroeconomy, that excess demand is met from increased production. So in chapter 18, I tried to be as clear as I could, saying firms form expectations about inflation and they don't deviate from those expectations. So When demand is stronger than planned, then or expected, then firms see their inventories drawn down, and that sends a signal for firms to increase production. But there was no change in prices in that discussion. And similarly, if there was weak demand, firms would see their inventories build up, and that would provide a signal for them to curtail production. So we saw this correspondence with the output gap and so forth. But through it all, in Chapter 18, we did not consider changes in output prices. Now, what we're going to basically do is just relax that very extreme assumption. And the extreme assumption is that there's no price response, and recognize that, of course, when firms are faced with excess demand, either higher than what was expected or lower than what was expected, then they may both, in the case of positive excess demand, produce more. So again, we would still expect that firms would be selling out of their inventories to the extent that they had them, and that would provide an incentive for firms to produce more. But they might also observe their competitors raising prices, and so they as well could not sacrifice market share and still be able to raise their prices. And what that means, and this is important in the way in which we're going to depict this graphically, is that when it is the case that output rises above the level that we thought consistent with the expected rate of inflation, then prices and actual inflation will be higher than what was expected. And so, as we'll see later on, what this means is our focus. So, in the future, meaning future of these notes, our focus is going to be on the notion of unexpected inflation. So specifically, is inflation higher than expected? Is it lower than expected? And then translate that into what the actual level of inflation is. So, just again, by way of reminder, this is just another way of summarizing this. In Chapter 18, we were working in our picture with the output gap. So, again, you'll recall that we had a picture where we put the real interest rate on the horizontal axis and the output gap on the horizontal axis. We had an IS curve, and we had, hard to see there, we had an MP curve, and we talked about fluctuations in the size of the output gap, and at that point in their implication for the real interest rate. What we're about to do now, sort of slowly through Chapter 19 and then kind of drive the whole thing home in Chapter 20, is to link this to price behavior in the macroeconomy. So our output gap is the difference between actual gross domestic product and potential as a fraction of potential. And our observation was that in this Chapter 18 material, that when there was excess demand, that would lead firms to produce more. Sorry. And if firms are producing more, if Y is going up, then it's the case that the output gap becomes more positive. And that's going to, in our case now, so this was our Chapter 18 stuff. And now we add in Chapter 19, the observation that this could also lead firms to increase their prices, which would cause actual inflation to rise above the level that was expected. Similarly, oh dear. Similarly, if it is the case that we have insufficient demand for goods and services or weak demand, so perhaps the IS curve shifts to the left for some reason, then that might lead firms to produce less output. It would lead firms to produce less output, which would make the output gap less positive. In other words, moving that direction, and that's going to lead firms to and it could, again, in the Chapter 19 edition, lead firms to decrease their prices. So again, as we saw before, this is our story from Chapter 18, and now we're just adding a layer of richness to it by incorporating the possibility that prices can change. So this now allows us to talk about what we mean by demand pull inflation. So demand pull inflation is the second reason why there is inflation in the macroeconomy. So again, we said inflation in the macroeconomy is the result of inflation expectations demand pull inflation, which is what we're considering here now, and cost push inflation. So demand pull inflation is driven by the output gap. It is something that leads actual inflation to diverge from inflation expectations, or in other words, leads to unexpected inflation. So these two bullet points are saying exactly the same thing. So saying that inflation diverges from inflation expectations is the same as saying that there is unexpected inflation. So unexpected inflation, in other words, is the difference between the actual or realized inflation and the level that was expected. So again, that expected level is going to be based on firms looking ahead in the future at costs and competitor behaviors and making a decision about how much prices are going to be rising. The Phillips curve is an illustration of the link between the output gap on the one hand, which is what we need because we had the output gap, of course, floating around in our chapter 18 material, and this concept, unexpected inflation. And so what we will show is that movements along the Phillips curve are the way in which we'll graphically represent the idea of demand pull inflation. So, restating, kind of going back to our earlier slide and just trying to restate what we saw, restate what I just said in anticipation of drawing a Phillips curve is the following. So, the gray stuff here up at the top is exactly what I had, say, 2 or 3 slides ago. And when we consider, first of all, say, excess demand, we said, we have this underlined part, that if there is excess demand, the output gap becomes more positive and actual inflation will rise above inflation expectations. So what am I saying here? So this bullet point is getting at this. When the output gap is positive, or in a somewhat more generalized sense, when the output gap is becoming more positive, unexpected inflation is positive or getting bigger, and in other words, inflation is higher than expected. The second bullet point is what we're describing up here. So we see this relationship between the output gap and what's happening to actual inflation. So when the output gap is negative, or in other words, becoming less positive, to use the formal language of the book, unexpected inflation is negative, or in other words, unexpected inflation is uh, becoming, well, I'll just leave that alone. It's becoming smaller. And inflation, then the actual realized inflation will be lower than expected. And so we see that if the output gap is positive, then we have positive unexpected inflation. If the output gap is negative, then we have negative unexpected inflation. It then follows that when the output gap is zero, in other words, when the economy is operating at full employment or zero output gap, then inflation is equal to the expected level. Inflation equals the inflation expectations, and by definition, unexpected inflation is zero. So what we're going to do is take all of these words together and put them in a picture. So this is a depiction of the Phillips curve. The Phillips curve is named for an economist known as Ben Phillips, who in the I don't know, either late 1950s or early 1960s, took it upon himself to just plot the relationship for UK data from the mid 1800s to the late 1950s on inflation and unemployment. And what we're doing here, of course, the output gap is telling us something about, so we can from this infer something about unemployment. But but we have in this depiction of the Phillips curve a somewhat more modern take on it. So what do we observe? We observe that when the output gap becomes more positive. So as we'll see in the next picture, we're going to suppose, say for instance, that this is 0%. When the output gap becomes more positive, there is a positive excess demand, right? The demand for goods and services exceeds current production. Unplanned inventories drop. Firms will respond by producing more, and the output gap, of course, then becomes positive. And they may as well respond by increasing prices. And as a result, we would see that the rate of inflation will rise above expected. So in this particular picture, we see that unexpected inflation, which is what's sitting here on the vertical axis, is, say, 1%. So in other words, in this particular example, we could say, suppose expected inflation is 3%. So I'm just making up that number for our purposes right now. And suppose then what we know is when the output gap is 0, then actual inflation is equal to expected inflation, which in this particular case would be 3%. Now, what this depiction of the Phillips curve is telling us is that when the output gap is 5%, unexpected inflation is 1%. And so what that means is that the actual rate of inflation, the inflation rate itself, is the expected rate of inflation plus the rate of inflation that is due to these demand pull factors, which is this 1%. Right? That is that. And we would say that the actual rate of inflation is 4%. That's what we mean by inflation rises above the level that it was expected. So when we see the economy start to heat up, that provides an impetus for firms to be raising prices, and inflation rises as a result above the level that people expected. When it is the case that the output gap is 0, we observe that there is no unexpected inflation. So in other words, if we were at a point like point B here, if it is the case that the expected rate of inflation is 3%, then at point B, actual inflation is as well 3%. And what this picture is telling us is that if we consider point C, if output is less than potential output, so if it is the case that the output gap is negative 5%, then unexpected inflation is negative 1%, right here. And we would infer that actual inflation is the amount that was expected plus the amount that is due to this demand pull factor, which in this case is negative. And so actual inflation is 2%. So again, as the output gap becomes more negative or less positive, unexpected inflation falls. And when the output gap itself is actually negative, the level of unexpected inflation itself is negative, and that reduces actual inflation, in other words, below the previously or initially, whatever word you want, expected level. Okay. So this is kind of confusing to think about. I think it took me a while to kind of puzzle through this. And so again, what we're measuring on the horizontal axis, of course, is the output gap. On the vertical axis, we're measuring unexpected inflation. So we take inflation expectations as given. So this is given and held fixed throughout the analysis. And we look and we see, is the value of unexpected inflation. We look and see what the value of unexpected inflation is. And from that, we solve for actual inflation. So our thought process here with in terms of analysis is take um, take the expected level of inflation as fixed or given to us. So firms at the outset form an expectation about inflation. If there were no other kinds of goofy things happening in the macroeconomy, demand side or supply side, then that would be the level of inflation. Then what you do is look at the output gap to determine the degree of unexpected inflation. And then you calculate actual inflation, or the realized inflation, is the amount that was expected, in this case, plus the degree of unexpected inflation, in this case, due to demand pull factors. Because what we're going to see is that we're going to have a similar sort of thought exercise when we talk about cost push inflation. So with that, what I would like to do is to kind of show you that empirically, this relationship between unexpected inflation and the output gap holds for the United States and for most other developed economies. What is interesting from an empirical point of view is what the slope of this line of best fit is. You can look in the textbook to see the description of how this line is determined. It's beyond the scope of our class. It's basically regression analysis for those of you who are interested in statistics or you've taken a course of that sort. If you were interested in learning more about what was happening in the late 1970s and especially the late 1960s and early 1970s, what you can see, I reproduced or placed linked on Canvas is a discussion of this, and so I think it's a fascinating period of economic history. I'll have a little bit more to say about it when we get towards the end of these notes. So, why is there inflation in the macroeconomy? Again, that is our objective. There is inflation in the macroeconomy because of inflation expectations. There is inflation that additionally may arise in the macroeconomy because of demand pull inflation. And now, what we want to do is introduce the third reason why there is inflation in a macroeconomy, and that's what's known as cost push inflation. So again, abstracting from this last element, if there is no output gap, then by definition, there is no demand pull inflation or unexpected inflation. The actual rate of inflation is the one that's expected. So in other words, what this bullet point is telling us is if 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 that is zero, if that's zero, then again, the actual rate of inflation that prevails in the macroeconomy is just the one that was expected. So whatever that level is, that's the one that prevails. Demand pull inflation is represented, as we saw, by a movement along a Phillips curve. So as the output gap becomes more positive, then there is increase in unexpected inflation, and we're sliding along a given Phillips curve. to a higher level of unexpected inflation and therefore inflation. When the output gap becomes less positive, we have the opposite happening. So perhaps it's not surprising if we're describing movements along a curve in the spirit of economics, we would then move on to shifts in a curve. And indeed, that's exactly what we're going to turn to next. We're going to illustrate the idea of cost push inflation, and we're going to describe it graphically as shifts in the Phillips curve. So, what is cost push inflation? Cost push inflation, again, is the third reason why there's inflation in the macroeconomy. And it occurs when there are what we call in economics supply shocks. And supply shocks are unexpected changes to production costs that push sellers, of course, to change their prices. And again, like with demand pull inflation, what we're emphasizing here is unexpected. If it was expected, it would have already been incorporated into inflationary expectations, and we wouldn't have this element. So, with demand pull inflation and cost push inflation, it's absolutely always something that's a surprise that's happening. So, in terms of story problems, it has to be worded as suppose all of a sudden the following thing happens, then you know that something's going to be happening on the demand side, or excuse me, in terms of demand pull inflation or cost push inflation. Again, as we saw with demand pull inflation, if there is cost push inflation, that's going to lead to inflation diverging from the level that was expected, and therefore, equivalently, leading to unexpected inflation. But rather than describing this as a movement along the Phillips curve, we're going to see that the graphical representation is different. And specifically, we're going to be talking about a shift in the Phillips curve. So, in particular, cost push inflation is going to shift the Phillips curve, and the factors that will cause the Phillips curve to shift will be unexpected changes in one or several at the same time of three things. So the Phillips curve is going to respond or is going to shift in response to these changes. These changes are what's known again as supply shocks. So they're so named because they are affecting the ability of the firm to supply goods and services at the same price as they were before the shock. So what are these? Input prices, productivity of factor all of the factors of production, but often what's focused on is labor productivity, and then exchange rates. And a little pet peeve of mine in the textbook, they are not making a distinction between real and nominal exchange rates. I want to emphasize that it has to be real exchange rates that are changing here, in the same way that real exchange rates are affecting changes in net exports. So we will see in our picture next that the Phillips curve is going to shift up when any of the following happen, or all of them if you wanted. When input prices rise, when there is a deterioration in productivity or productivity falls, and then third, if there's a depreciation in real terms of the currency. And conversely, of course, the Phillips curve is going to shift downward when we have the opposite. Input prices fall, we have a productivity improvement, or there's a real appreciation of the currency. So in this particular case, we are going to be focusing on the Phillips curve shifting up or down, not a right-left thing. And we'll see that in the next slide right now. So let's consider higher input prices. Higher input prices are going to shift the Phillips curve upward. And so what we're saying by this notion of up is that for any value of the output gap, so for any output gap, or for all output gaps, however you want to think about it, for any value of the output gap, um, if there is a surprise, a unexpected So a surprise or unexpected increase in input prices will mean that this is an unexpected increase in firms' costs of production. So if a critical input becomes more expensive, or we have wages go up, for instance, then that would be something, and it's a surprise, then that would be something that would unexpectedly increase firms' costs, and that will mean that unexpected inflation is going up. Um, and by extension, then the realized rate of inflation also goes up. So we have the same sort of logical approach that we had before. So this would be true, for instance, if the output gap were zero. Suppose it's the case that some critical input price goes up, then what does that mean? If initially we had, say, expected inflation, as we said, of 3%, then what we're talking about is becomes more expensive for firms to be producing because of higher input prices, then unexpected inflation would be higher. So maybe this is what, 1.25. So we would see in our example going from A to B, for instance, A to B here means that we have unexpected inflation of 1.25%, and rather than inflation being 3%, as it would have been at point A, at point A we would have actual inflation of 3%. At point B, the actual rate of inflation that would prevail in the macroeconomy would be 4.25%. Similarly, we could observe that relationship, that idea, regardless of what the output gap is. And importantly, when we look at picture, if we were at, even if we had an output gap that was negative, so suppose that we have output that is below potential. If we have a supply shock in the form of, say, higher input prices, or indeed any of the supply shocks that we're going to describe, the economy can still be producing below potential and see an escalation in the rate of inflation. And that's something that is sometimes surprising. We tend to think, oh, if the economy is producing below full employment, then the tendency should be always for prices to the rate of inflation to be dropping. But of course, what we're going to see is that is not necessarily true. So we can see an economy experience, say, a stagnation in the production of goods and services, and yet inflation. And in the next chapter, we'll refer to this as the existence of stagflation. So we'll see this in, I'll introduce this again in chapter 20. But this is exactly the idea, that we can have output falling or stagnating, so GDP falling or the output gap becoming increasingly negative, and increases still in inflation. And that's going to be happening because we have these kinds of adverse supply shocks. So let me also use some more econ lingo. When we talk about supply shocks we think of as being adverse supply shocks, is the way that we describe this. So adverse supply shocks, that would be one in which we have an escalation of costs facing firms, and graphically we would be depicting it as we are now with the Phillips curve shifting up. And favorable is the alternative, or positive. Favorable or positive supply shocks are the two adjectives you'll hear the most. And that, as we'll see, is going to be illustrated by the Phillips curve shifting downward. So what I would like to do is to talk for a second about, see if we can get this to, whoops, do this again. Talk about a particular problem that can arise in an inflationary environment when, especially when we have these supply shocks. So all increases in input prices can be problematic in terms of the way in which they ripple through the macroeconomy. But one of the things that we tend to observe is that when the initial shock in the economy comes through, say, commodity prices, particularly oil and gas and other energy prices, those tend to be somewhat volatile, rising and falling, with the result that those kinds of supply shocks are somewhat more transitory. So, something that can be problematic, however, is either a supply shock that feeds through to what's known as a wage price spiral, or just the original source of the supply shock is to labor prices, which are wages. So we've seen reasons prior, specifically the problem of money illusion and efficiency wages, why there can be downward wage rigidity. And so, in an inflationary environment, when that starts to feed through to wages, this can be particularly pernicious in their ongoing inflationary impacts. And it can result in what's known as a wage price spiral. So, the illustration in the textbook, it almost doesn't matter where you start, but we'll start here. Suppose it's the case that for whatever reason, wages rise. That raises, of course, firms' cost of production. They're going to feed that through in the form of higher prices to final goods products. That's going to mean that when we all go to shop for those things, our spending power is reduced, our purchasing power falls of a given amount of income that we have. And so we turn around to our employers and we'll try to the best of our ability to negotiate nominal wages. And to the extent that that cycle continues, so further escalation, further price increases, reduction in spending power, and so forth, we can enter into this notion of a wage price spiral. So, in other words, when there are particularly supply shocks that then feed into these kinds of wage price spirals, it's particularly important and potentially problematic because they can amplify the effects of what would have otherwise been a temporary inflation shock and make it more persistent. So this indeed was one of the problems. We'll show a graph at the end of these notes of the inflation spiral that happened beginning in the late 1960s, but really took off through the 1970s and then reemerged in the beginning part of the 1980s. You know, people saw inflation eroding the purchasing power of their income. They negotiated higher wages. Those wages then got fed through, and it continued. So we have this problem, this spiral of workers are responding to inflation by demanding higher wages, and that leads to higher prices, which leads to more inflation, higher negotiated wages, and so forth. Now, I feel like when I introduced this slide, certainly I thought long and hard about it, that I'm almost touching the third rail, which is to say, oh, well, we should never see wages rising. That's not what I'm saying here. So please don't misconstrue this as inferring anything about my advocacy for minimum wages, $15 an hour wages, any of that. What we are starting with here is some kind of supply shock that was unexpected. So I'm not saying that we shouldn't pay people more because then we'll lead to a wage price spiral. Rather, what I'm emphasizing here is that expectations matter, and it's about managing those expectations. And why, for instance, if you think about public policy, no one is talking about surprising the macroeconomy with, a $15 per hour minimum wage. Indeed, everything that you hear or read is not like, let's jump the wage tomorrow to $15 per hour. It is, let's see a steady escalation of the minimum wage over several years going forward. Why is that? Why do we advocate, or why do you see policymakers going for that incremental phase in? Well, of course, part of it is politics, but part of it too is that if it's announced and fully anticipated, then it'll be incorporated into inflationary expectations, and it's very much less likely to, if at all, indeed, to cause this kind of persistent inflation problem or wage price spiral throughout what we're talking about with demand pull inflation and cost push inflation. It's always about a surprise. Demand is unexpectedly strong, or there's an adverse supply shock that raises firms' cost of production that is a surprise. Again, I want to emphasize, if price pressure is anticipated, it is incorporated into inflation expectations and becomes realized according to what we talked about at the outset in these notes. So we can also then consider the other two general reasons why we would see a change in the position of the Phillips curve. So productivity factors. If we have slower productivity growth, what does that mean? That means that we have less output per, say, worker per any unit of the input, or per unit of input, if you want to do it that way. And so that means, in other words, just flipping that on its head, to get one additional unit of output requires more inputs, which of course raises costs. And then, on and on, we see firms respond to those unexpectedly higher costs, in part by increasing prices. Inflation rises above the level that was expected, or in other words, there is higher unexpected inflation, and that would be the Phillips curve shifting upward. Similarly, if there is faster productivity growth, then that means that we see less or we see more output per unit of input. And so getting one additional unit of output requires less in the way of inputs, and therefore costs less, and there is therefore less price pressure, or the Phillips curve is going to shift downward. With exchange rates, what we focus on is whether the appreciation or depreciation affects foreign goods prices. So when we have and I guess let's be consistent here. We'll take this one. If it is the case that we have a depreciation in the dollar, then that means that the rest of the world's goods and services are more expensive in US dollar terms. And to the extent that these rest of the world's goods, these would be inputs, to the extent that these imports are inputs, I want to enunciate, to the extent that imports are inputs, then the depreciated currency will raise the cost of production. So raise production costs. And we would talk about the Phillips curve shifting upward. And then again, similarly, if it were the case that the dollar were to appreciate in real terms, then that's going to mean that the rest of the world's stuff becomes less expensive in US dollar terms. And as a result of that, imports are going to become cheaper to the extent that those imports are inputs to the production process, then that's going to result in a lower cost of production, and we would talk about the Phillips curve shifting downward. So I want to pause for a second before our last couple of slides and introduce a participation question. Goodness. Okay. So before kind of wrapping this up, what I want to do is point out something I haven't tried to suggest to the contrary, but looking at the Phillips curve can be tempting to think about it as presenting choices to policymakers. So, in other words, again, our Phillips curve looks like this, right? We have the output gap on the horizontal axis, and we have unexpected inflation on the vertical axis, and we have this Phillips curve that looks like this. What it sort of suggests to us is that we could be, so this is our zero. If it is the case that we just had, push the economy a little bit harder, we could have a more positive output gap. And the sense in which that would be good is that if we have more output, then we have lower unemployment, higher incomes potentially, um, and good things that come along with that. And what's the price, if you will, in quotation marks, that we have to pay? Well, higher inflation, right? We'd have more unexpected inflation. We'd kind of slide along the Phillips curve like that. Or instead, what we could do is have less output and lower inflation. That's what the Phillips curve seems to suggest. But what I want to do is say that that's not quite right. Indeed, US policymakers, and perhaps those in other countries as well, made a fatal flaw in the late 1960s and the beginning of, and through the first part of the 1970s, perhaps, trying to exploit, if you will, this relationship between output and inflation, and juice the economy partly out of necessity. End of the 1960s, of course, again, we had Vietnam War funding in the United States, but then also very aggressive efforts at introducing social policies, which were very much needed, but expensive, and some fairly generous tax cuts as well. And so what happened is that when these policies were initially implemented, the economy didn't overheat right away, all of a sudden. It was kind of like, yeah, all right, fine. We see a little uptick in the rate of inflation, but look at these other things. We've got low unemployment, we've got higher incomes, the economy seems to just be doing quite well. Everybody was sort of happy. But what was painfully learned coming into the late 1960s and the early 1970s, and then exacerbated with energy price shocks in the 1970s, and again at the start of the 1980s, was that you can't have that trade-off last permanently. So when policymakers tried to push output above the potential level, what happened, of course, and the Phillips curve tells us this, is that there was unexpected inflation. So, in other words, inflation was, of course, pushed higher than what people had anticipated. And having that happen one time or two times is not bad. But after a while, decision makers kind of start to look at the world around them and say, okay, you fooled me once, shame on me. You fooled me twice, shame on me. But you're not going to fool me again. And so it became increasingly difficult to just have this kind of sliding along on the Phillips curve where expected inflation also didn't change. And what happened then was that these sort of persistent surprises, persistent realizations of unexpected inflation, eventually, in the longer run, caused people to begin to expect higher inflation. So we saw not only these demand side influences kicking inflation up, but then again, to the extent that we remember that inflation itself, right, the actual rate of inflation is what was expected, plus the inflation that's due to demand pull reasons, plus the inflation that's due to cost push reasons. What was happening is that rather than having this element be fixed, it started to rise too, and rose quite dramatically. And all the while, through the late 1960s and good chunk of the 1970s, there was demand pull pressures. We had oil price shocks, among other things that were happening on the supply side. There was some productivity slowdown that was also happening. So that was tending to push up inflation. And we just had this kind of self-fulfilling prophecy of higher and higher inflation in the macroeconomy. Indeed, this picture is similar to the one that is in the textbook, although I didn't pull it from the textbook. I generated this myself, going to the Philly Fed website. What you can see here is that in red, we have the actual rate of inflation, and in blue, the expected rate of inflation. And notice that in the, so this goes from 1968 to the present. You can see in the late 1960s, early 1970s, actual inflation is sitting higher than expected. And what happens? Eventually, expected inflation starts to tick up. And for a big chunk of time, actual inflation is still higher than expected, and expected inflation starts to work its way up. This is recessions in here. I didn't shade. I should have, I guess. And then further escalation in energy prices. We have the Iranian hostage crisis in 1979 that was causing this uptick in inflation. In here, again, if you go into some of the that Fed article that I linked into Canvas, 1979, in October of 1979, we have Paul Volcker, Bolcker, who was the Fed chairman, put out a statement saying, yeah, inflation is a problem and we're going to address it right now. And the economy dragged through a very painful recession in the 1980s. And the recession is negative demand pull inflations, demand side, but pushing in the opposite direction. And you can see this very sharp, again, red is the actual. You can see this sharp downturn in actual inflation in the economy as this recession it was a double dip recession, but dragged on, and it was quite painful. Not perhaps as well the Great Recession that we had in the last decade, and that certainly rival on many dimensions. What's interesting during this time period, of course, is that you see actual inflation tracking below expected. It took a long time for people's expectations of inflation to drop either to the level of actual inflation or below it, as you tend to see. And there are some interesting periods, say in the early 1990s, we had a bit of an uptick in economic activity, and people were convinced that we were going to return to the period of the 1970s. And for reasons that we'll talk about a little bit in chapter 22, the Fed during this time period was like, paraphrasing, "Oh, heck no, that's not going to happen," and was very credibly committed to maintaining a low inflationary environment. And you can see, and we've talked about earlier, this period is called the Great Inflation, beginning in the late 1960s. And then we have, of course, the Great Moderation. We like the word great in economics, I guess. But going from the 1980s to the present in the rate of actual inflation and, importantly, expected inflation. And interestingly, you can see the great volatility in actual inflation that has occurred as a result of the Great Recession, which is right there. And as we've gone through this rather tepid recovery, and then, of course, here's COVID. And through it all, sort of underneath there, you can see the blue expected rate of inflation is not really deviating very much from 2%, which interestingly enough is what the Fed has said its initially unofficial and now somewhat more official target rate of inflation is. And we'll consider this a little bit more carefully in the material in chapter 22, but I think it's interesting to see the relationship between expectations and how they get fulfilled, and that it really is this kind of realization of what people expect in the macroeconomy. So, to sum up, what we have seen is that if we were going to describe inflation, again, the actual rate of inflation is going to be what is expected plus any demand pull inflation plus any cost push inflation. And so, what causes demand pull inflation? Demand pull inflation is a reflection of things happening in the output gap. Excess demand is leading to rising prices. And the way in which we're going to depict this is to look at movements along the Phillips curve. When we talk about cost push, so this is demand pull, of course. Should have labeled it, but I didn't. Down here, we're describing cost push inflation. Cost push inflation is happening because we have supply shocks. So these are adverse supply shocks, and these are positive or favorable supply shocks. So adverse supply shocks shift the Phillips curve upward. They cause, again, higher inflation in the macroeconomy, and favorable supply shocks do the opposite. They'll result in a downward shift in the Phillips curve and result in lower rates of inflation in the macroeconomy. So, what are the key takeaways? Inflation is caused by inflation expectations, by demand pull inflation, and by cost push inflation. The Phillips curve is the way in which we're going to link developments in the real side of the economy, meaning what we talked about earlier with the ISMP model and especially the output gap, to changes in the rate of inflation. Supply shocks can be particularly difficult to deal with as a practical matter if they lead in turn to wage and price spirals. And we don't have sort of a menu of policy choices along a Phillips curve. The Phillips curve can tell us about demand pull inflation and cost push inflation, but we can't sort of persistently, as a matter of public policy, use expansionary policies because they'll result in increasing inflationary expectations and then an escalation in underlying inflation. Indeed, some of you for your countries have picked very interesting countries that are undergoing or have undergone in the time period that you're going to be looking at them hyperinflationary episodes. And I'll be very curious to see you identify these kind of spirals that we're capturing and talking about here. Sometimes they come from the supply side, sometimes they come from the demand side, but it is that persistent use of expansionary monetary policy and fiscal policy in response to an initial shock that causes this spiral of inflationary expectations, and importantly, not any persistent improvement in real GDP. So the corollary or reduction in unemployment. And so the corollary here that we'll see in chapter 22 is that especially monetary policymakers can promote stable rates of inflation by credibly committing. So by undertaking actions and words that are believable, um, credibly committing to a low inflationary stance. So what's next? I'm super pumped. In chapter 20, we just get to play. So we just put these things together, and the IS and MP framework and the Phillips Curve framework, and we are in a position then to describe the movements of the macroeconomy over the business cycle, interpret how monetary policy and fiscal policy affect interest rates, the output gap, and inflation, and then to also use this as a way of deducing what's happening. So if we observe certain things happening in the macroeconomy, we can use this framework to infer what the source of the shock is. And that's important because then that can help us think about how we might craft a monetary policy response. So, or a fiscal policy response, I'm sorry, a policy response generally. So, I think at this point I was going to do another participation question, but I think we're done. So with that, look ahead to next week. This ends it for week 10 in terms of material. In week 11, we will just take this picture that is in front of you and manipulate it in all the ways we can. And so we'll have lots and lots of fun playing with graphs. Have a good weekend. Talk to you later.